If the markets and things are so good right now, is it looking like a time to maybe take some profit off the table or just continue to invest in the strength?
I mean, the way we think about it is that equity markets never peaked more than 13 months before a recession. So if you're comfortable that there's no recession through the summer of next year, which we are, then it makes sense to still be overweight equities at this stage. I think
riding it out.
Yeah, I agree with the broad principle that your best returns come when the economy is at the worst point, when you're buying on very cheap multiples. So I'd expect lower returns from here in the late stage of the cycle. But we think we've got a little bit further to go. I think the risks start to build as the Fed hike interest rates throughout the rest of this year and then through next year. I think that starts to put some risks perhaps for 2020 in play. But it's a bit too early to be pricing that. As I say, the market tends not to price more than a year ahead.
If you're under 35 years old in the United States or in Europe, you've never managed money in a rising interest rate environment. We haven't really had one since 2004, 14 years ago, Mike. So how do we know that the men and women out there that are going to be allocating capital are going to be able to do it in an interest rate environment that they've never seen if they're under 35 years old?
Yeah, I guess the key thing is if you look at rising interest rates, historically rising interest rates weren't a problem for equities. You look at the last cycle, interest rates went up. It's only when interest rates get to the point where it actually starts to cause some problems, obviously last time in the housing cycle or in the corporate sector in the past. I mean, our view is that the housing sector looks fine this time around. The concerns are more on the corporate side. So you look at leverage, particularly within US investment grade credit, that's starting to look a little bit more
record
concerned.
amounts of corporate debt globally on the books in that same rising rate environment. I'm not trying to be Chicken Little and say the sky is falling, but when you've got raising rates and record amounts of debt, it's not hard, Mike, to put together that scenario where bad things can happen.
Yeah, I think that is the medium-term risk. So as interest rates go up, I think eventually it starts to potentially cause a little bit of a squeeze. I mean, the upside risk to that is that if you get a productivity pickup, because businesses' investment is looking pretty good at the moment. Look at the NFIB survey, and a near record amount of businesses say now's a good time to expand. So if business investment picks up, productivity growth could offset some of that rising wage pressure and rising interest rate costs on corporate margins. But I do think now is the time to be more cautious on investment grade credit, but not yet getting cautious on equities. So there's still a little bit room to run there.
Are you in the recession maybe likely in 2020? We're starting to hear a few people like Skype Minard of Guggenheim and others say not next year, but maybe in a year and a half. Things are so hot they could slow down. And if that's the case, then to your point, you've got maybe another year left in the equity markets?
I think that those medium-term risks are certainly building. With the fiscal stimulus from the US, it looks hard, certainly in the sort of first half of next year, to get a recession, because you're still going to be getting quite a sugar rush come through from the fiscal stimulus. But as interest rates go up in response to that strong growth, I think it does pose some risks once you look at beyond the end of next year. And obviously, as I say, the market tends not to price it more than a year in advance. So I think you've got at least another 6 months through the end of this year for equities to do well, and then you've got to become maybe a little bit more cautious.
And does the U.S. market have a bit of a secret weapon in stock buybacks? Stock buybacks right now, record highs.
Yeah.
And when we talk about, oh, can you get earnings growth? It's a lot easier to match targets on earnings when you buy back a bunch of your stock.
I think it's absolutely key, and I think it's also very important for investors to look at the buyback yield. So people look at the S&P 500 yield and just on the dividend basis and say, well, it's not that attractive globally. Add in those buybacks, and it really is, particularly with some of those financials. So we look at some of the financial stocks in the US where, including the dividend yield and the buyback yield together, you're getting really very healthy returns, even if the share price stays where it is. So we like US financials within that context.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.